Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Shares of Maple Leaf Foods are rallying today, one of the few companies doing so. It's up about a little more than 7% right now after it reported higher fourth quarter profit and revenue that topped estimates. The quarter was boosted by the spin-off of its pork business as well as sales from its prepared foods and poultry units. Maple Leaf says it expects continued revenue growth and further margin improvement in 2026 as it focuses on operational efficiency and strong demand for protein products. Shares of Canadian Natural Resources also trading higher, not as much though, only up 1.1 right now. The country's largest oil and gas producer posted revenue that topped estimates in its latest quarter, as well as better than expected profit. The results were helped by record production that offset weaker oil prices. Output rose nearly 13%, the company raising its 2026 production forecast. It also boosted its dividends. Kinaxis is one of the better performing stocks on the TSX today. The supply chain management firm saw revenue surge 16% versus last year and topped estimates. Profit also came in well above consensus, and the company's full-year revenue outlook was better than expected. Robust demand and record booking also fueled the quarter. Analysts note the results signal strong momentum. We'll be talking to their CEO shortly. And the markets. The yo-yo continues this week. The TSX, it opened slow and then it just took a crash. It's down by 1.68% right now. South of the border, not much better. In fact, probably a little worse. Everybody's above 1% in losses. The S&P 500, 1.28, 1.29. The Dow off by nearly 2, and the Nasdaq is off by almost 1.2 right now. And of course, all this, we see oil prices pushing higher, the geopolitical tensions in the Middle East, Iran specifically, that Dow skidding down more than, as we mentioned, I think it was more than 800 points. So let's get perspective on this now from our next guest, Brian Mulberry, Chief Market Strategist at Zacks Investment Management. Brian, thanks very much for joining us. Another roller coaster day, this time on the down.
Yeah, absolutely. We're getting close to that psychological barrier of $80 per barrel of oil, as you were just talking about. The market's going to be really concerned about that level. If it's sustained at $80 or higher for a long period of time, it just makes the cost of everything go up. That reignites inflation fears. It means that, maybe interest rates don't go lower the way this market has priced in so far this year. So you can see the obvious negative impact that's having in markets right now.
And how long does it have to stay at that $80 before it really becomes an issue? I mean, nobody really wants to, unless you have oil companies, then you want to see it. But for anybody else, how long before it does become a legitimate issue?
Yes, that impact has to last for months, not just weeks. And the obvious issue that we have right now is a still shooting war that's going on in Iran. While the conflict is going on, we can certainly understand why tensions would be high. It's causing some disruptions in the supply chain. Obviously, the Strait of Hormuz is not seeing the normalized traffic that you would see in terms of oil tankers. It's also disrupting refinery. So while all this is going on, temporarily, we can understand why prices are spiking. It's if it stays there all the way through the summer months that you would have that material impact on the economy going forward.
And it's so early, it's so hard to say, but does it look like it might be leaning that way?
Well, that's the fear of the market right now. There's no way to really tell exactly how long this is going to last, and then how long does it take to normalize all of the supply, right? The bottleneck that's happening at the Strait of Hormuz, the bottleneck that's happening in terms of refining capacity being lowered temporarily during the conflict. There's no way to really tell how long it will take to get all of that back and running to the pre-conflict levels.
I'm just looking, I think we're seeing gold down, silver, other natural resources, silver and copper. Copper's also taking a hit today, some of the copper companies at least.
Yeah, I think we're just kind of seeing, that flight to cash at this moment in time. This is one of those stressful periods when you start to see all assets moving in the same direction at the same time. People are just looking to try and get out of the market any way that they can at this moment. I think that, it'll be a little bit easier to find a floor on a day like today because we have had a bit of a washout earlier. The stress that we saw on some of the software stocks from AI already pushed people into a bit of a risk-off mood as we come into this conflict here today. So I don't know that this is necessarily going to be the catalyst for a huge drawdown, but we do definitely see that risk-off mood in the market right now.
And we're actually seeing some people move back to some of the software companies. We're up this morning. I haven't seen them in the last 5 minutes, and it's like the weather right now, right?
Exactly. It's moment to moment right now. But you're exactly right. We did see the NASDAQ in particular doing better here domestically, where we saw people taking advantage of some mispriced stocks. Those anomalies are going to continue to happen as we start to see volatility continue to increase. And one of the best performing assets out there is the VIX index itself, up almost 54% on a year-to-date basis. So that just simply signals we don't know what we don't know. That means uncertainty causes volatility, and we're going to have to decide how much appetite you have for risk in a moment like this.
All right, Canadian Natural Resources reported revenue and profit that beat estimates. Where can Canada benefit from? We are benefiting a little right now. The stronger U.S. dollar, we're kind of along for the ride with the higher oil prices. But I mean, we need some long-term changes if we're going to benefit from this, don't we?
Well, what you're seeing is record production coming from Canadian natural resources, especially on the oil side. Natural gas, they're more or less at capacity for what their infrastructure can handle. So natural gas growth is flat, but still operating at 100% capacity. Oil is up, 13% quarter to quarter, up 15% in terms of production year over year. They're obviously taking advantage of the high commodity prices and well positioned to do so. Again, to your point, the one way that you can hedge against higher energy costs is to be owners of these types of companies.
And how are you looking at, if you're looking to buy right now, how are you looking at buying?
Well, I mean, I would want to be a little bit strategic. Again, this is all about how much risk you feel like you want to have in a market in a moment like this. The floor on oil recently has been between $55 and $60 a barrel. As we approach 80, that would give us a little bit wider trading range, but I think the support is still probably at that $60 a barrel, which still means that companies like Canadian Natural Resources should be profitable. I might want to hedge that by owning more of the refinery stocks, something that would be along the lines of Conoco, Exxon, Phillips, something along those lines to kind of offset the risk in production, and that kind of helps hedge against the commodity price itself. Refiners typically run at 90 to 100% capacity all the time because there's no shortfall in demand for things like diesel, gasoline, and those types of products. So there's different ways that you could go about this, but still manage your risk budget, I think, intelligently.
All right. And going the other way, what are some of the things you're staying away from right now?
Well, the volatility that you're seeing, I think, in some of the technology names is real. And there has to be something sorted out here in terms of which type of AI is going to win. Is software dead? No, I think you're starting to see people come back into some of these large software names because they realize that generative AI isn't going to take over everything, at least not right now. But there are going to be winners and losers. And so for us, it's going to be about cash flow. All of these major investments that have been made to grow the AI infrastructure have to come back to some of these companies, but it has to also do so in a profitable way. For an example, Microsoft spending $200 billion this year just to grow data centers. When do they get that money back? And when they do see it in terms of sales and revenue, is it going to be profitable growth for them? I think investors are right to ask some of those types of questions, and there will be winners and losers in this space as time goes on.
Okay, we'll wrap it up there, Brian, but thanks as always for joining us.
Thank you.
Brian Mulberry is Chief Market Strategist at Zacks Investment Management. When we come back, we'll take a closer look at some of the trending trades moving the markets today, including Victoria's Secret. Welcome back to Trading Day. Let's see what is trending today. And there are actually some gainers today, believe it or not. Maple Leaf Foods, one of the bigger gainers right now. Its Q4 revenue was a good beat, and obviously people are liking it, what they saw. The Maple Leaf Foods right now is up more than 7%. Canadian Natural Resources, another one we're keeping an eye on right now. It is doing well, seeing another beat as well. Profits beat estimates, and the response up by 1.25 in a sector that is struggling today. So Linamar as well, the automotive parts supplier and manufacturer, beat the fourth quarter earnings per share, beat the average analyst estimate, closing in on all-time highs. It is up as well. And Kinaxis, one more we want to get in there that we should be talking about their results. Again, great results with a beat and what to expect moving forward. We'll be talking to Razat Gaurav, their CEO, coming up in 15 minutes. But right now, they're up as well, nearly 6%. So there are some winners today, but boy, oh boy, there's a lot going the other way, including First Quantum Minerals. It is down right now, 8.4%. One of their mine restarts has been delayed. Tourmaline Oil also down. Latest results having an impact there, and it is off by about 5.25. Couple of notes we want to do here as well. Broadcom is up. AI chip sales topping US $100 billion in 2027. That's what they are predicting. It's up 4.25% on a generally bad day. American Eagle Outfitters down in the States. Profit will be generated in the second half of the year. People not liking that, and investors responding. It's off 14%. And Victoria's Secret, latest results, hurting them right now. They were down, and it's off by 15.3%. One other note here, StubHub, their 2026 forecast for Q4, the results falling short due to the Taylor Swift effect. They were down 11%. On Taylor Swift, the power she wields. Coming up, women make up a sizable share of the workforce, but many face a gap in their earnings after children. We'll dive into that after the break. International Women's Day is Sunday, and we are seeing noteworthy signs, of progress in the wage gap. But the next guest says there's still a long way to go in reducing what's called the motherhood penalty. For more, we were joined earlier by Catherine Judge, Executive Director and Senior Economist at CIBC.
We are seeing some encouraging signs in terms of women with young children increasing labor force participation and increasing their contribution to families' earnings shares. However, when you look at women with children versus women without children, there's still a sizable earnings gap. So we looked at long-run motherhood penalties, and that's essentially the gap from the time that the first child is 5 to 10 years old. And that gap in Canada is on average 34%. So women with children are earning 34% less on average during those years than women without children. And that is much higher than in countries that have very accommodative parental leave policies, places like Sweden, where you see the gap at around 20%.
And is it strictly because of that then? Or are we seeing more equity? Are we in those countries, do we see more men staying at home as well?
So there are a few factors at play. There is research that shows in Canada, when subsidized daycare was introduced in Quebec in the late 90s, the motherhood penalty was essentially cut in half. Now, if we look at daycare enrollment rates in Canada, all provinces still trail Quebec greatly. So we know that increasing childcare enrollment engages mothers in the labor force better and narrows the gap. And then there also is the issue of unpaid childcare and household work, where women tend to do more. So women that are aged 25 to 44 do about 2 hours per day more than men on those tasks, which of course cuts into time that could be doing paid work. And we find there's a prominent body of research that suggests women are willing to trade lower paying jobs for more amenities and more flexible hours at work. And that's also tied into what's called the fatherhood premium, which is where men actually can benefit after a child is born by earning more because they choose to work more hours. So there are a lot of factors at play here.
Are we seeing more, as more women make more money and rise up the chain, are we seeing more men staying at home, and are they suffering a similar situation, or do you have those numbers even?
So you are certainly seeing more men contribute to the unpaid household childcare tasks that I was speaking about. If you look back a generation ago, the gap has closed, has essentially been cut in half. So that, in our view, is part of it. If you look at the earnings of men and women pre-children, they evolve essentially in the same way. And then there's an immediate drop in earnings for women, of course, that go on maternity leave. In the case where the woman has one child, the earnings penalty essentially goes away by the time the child is 10. But for women who have 2 or more children, the motherhood penalty is much more persistent and carries on much longer. So one factor, of course, would be equalizing those unpaid tasks, which would free up more time for women to pursue career development.
And you mentioned about the daycare. Are there other things that might make a difference, too, to close that gap?
Yeah, so one other thing we looked at is flexible work, which is defined essentially as industries where 35% of employees have adaptable hours. And we see that women's growth in employment is overwhelmingly concentrated in flexible industries. So that's another factor, of course, to consider. But I think the low-hanging fruit here is the continued expansion of subsidized daycare and getting those daycare enrollment rates up closer to what we see in Quebec so that we can lower these penalties in the rest of the country, because the fact is that we're just not utilizing the workforce to its fullest potential here.
And I mean, we saw that huge boom with work from home at the start of the pandemic. It's carried through. We're starting to see people come back to work. Has that had an influence as well, or is that essentially the flexible hours? Is that looked at as the flexible hours you mentioned?
So when you look at participation rate gaps, so for women with children under 6 versus women who don't have children under the age of 18, there's been a narrowing in that gap that started in 2019. There was a significant narrowing, so that does suggest that remote work and more flexibility was a contributing factor, although we don't have detailed data on that.
Okay, so and so we might actually see a dip again then, as more and more people have to go back to work, and it seems like the women are going to have to make a choice on if they want to go back to work or not, or stay home.
I think it's really about focusing on within couples on, sharing the childcare and unpaid tasks more equally. That's been shown to make a big difference, but there are a lot of factors at play here. But I think it's pretty nuanced in terms of each family's situation. We're still seeing, of course, the effects of subsidized daycare that has not fully been realized yet, and I think we will get positive impacts on women's participation as that continues to roll out.
And then overall, what's the gap between men and women? I mean, can you do it as a general? What is that at now?
So there is in Canada, the long run's earning gap in terms of the motherhood penalty is 34%. And then there's also the parental gap, and there's the gender wage gap, which of course persists. We have done prior research into the wage gap that shows essentially women aren't being increasingly represented in managerial roles. So it's really about breaking that glass ceiling to narrow the wage gap further, because if you look at prior years, progress on that really has slowed down.
That was Catherine Judge, Executive Director and Senior Economist at CIBC. Coming up, we'll sit down with the CEO of Kinaxis to discuss its fourth quarter earnings and more after that. Linamar shares are rising. They're up 1.5% right now after reporting fourth quarter profit of $110 million, reversing a loss from a year ago. The auto parts manufacturer also posted higher sales and says most of its products shipped to the U.S. remain tariff-free under the Canada-U.S.-Mexico trade agreement. Linamar also pointed to recent acquisitions, including the purchase of a German iron casting plant as part of its strategy to strengthen its portfolio. Spin Master posted profit and revenue in its latest quarter that both came in higher than analysts were expecting. The toy maker also saw an increase in sales in its digital games segment as well as its entertainment segment. On the downside, Spin Master says it expects revenue this year to be flat or in the low single digits compared to 2025. Shares of Broadcom are up about a little under 4.5%, we'll say right now, after the chip maker posted better than expected first quarter results. Profit and revenue topped expectations, and the company gave a revenue outlook for artificial intelligence that was well above consensus. The company now sees AI chip sales topping $100 billion US in 2027. Broadcom is also buying back $10 billion worth of shares. Another rough day for the markets everywhere you look. South of the border, the S&P 500 off by 1.33, the Dow more than 2, and the Nasdaq by 1.25. As oil and instability in Iran is what's driving everything right now. All right, Kinaxis reported a fourth quarter beat on both revenue and profit. The global supply chain company announced major investments in their agentic AI architecture and the Maestro platform. Let's hear more now from Razat Gaurav, the CEO of Kinaxis. And Razat, thank you very much for joining us today.
Great. Thank you so much for having me.
Some good numbers there. What drove it? Where are you finding your successes, and where were there laggards for you?
Look, it's really three things that are driving the growth and the momentum. It's firstly all the demand and supply volatility in the world, and our customers are trying to deal and grapple with this volatility, and they are trying to become more agile and adaptable. And our Maestro platform is helping enable that. So that's the first thing. Second, I think we've really improved our own execution and go-to-market motion significantly in the last 12 to 18 months. And then thirdly, there's a whole replacement cycle happening in the world of supply chain planning and decision making from old legacy systems to platforms that are really architected for moving forward in the world of AI and agentic infrastructure. So these three things are really what are driving our growth.
Now, and looking to your guidance for 2026, you're optimistic about it. But for the last month or so, SaaS and software stocks have taken a hit. Any concerns about that moving forward? The concern, obviously, that AI could be replacing them. How are you countering that?
Yeah, look, we've had a lot of discussions on that and had a lot of deep sort of thinking sessions on that topic. Our conclusion is that while AI, particularly generative AI and agentic AI, will have a profound impact on our solution domain, and we're leaning into that, we are very confident of what we've built in Maestro, which is really in reflecting the complexities and the interconnectedness of the physical supply chain in our digital Maestro platform, and then adding the intelligence layer with all the mathematical modeling, which involve deep optimization, heuristics, advanced machine learning, to help our customers make very important and strategic and consequential decisions on inventory and forecasts and material availability and manufacturing and production. All of those things don't get replaced by agentic AI or generative AI. They only get supplemented by generative AI and agentic AI. And we are leaning into that in harnessing the power of generative AI to create a conversational interface, to use the reasoning models. And with agentic AI, we're really trying to really expand from planning into an orchestration platform, a composable orchestration platform. So it's really exciting for us. And in many ways, we look at the latest advent of AI being a tailwind for us. But I know the financial markets have had a different point of view for all enterprise software companies, and we're in the penalty box right now. Our approach is to keep hunkered down on the first principles and creating value and innovating for our customers and performing on a consistent basis. And hopefully at some point, the markets will realize that this is a tailwind for us and not a headwind.
And any concerns with competition, maybe a little more nimble, a little smaller, coming up on you with the way AI is allowing people to kind of do leaps and jumps at times? Any concerns that you might face a competitor that you didn't expect to see?
Yeah, look, we're always, on our toes, and it's always day one for us, right? If I can say so, and we don't ever want to get complacent about any situation. However, having said that, we have a strong degree of confidence in what we've architected and built, and what we've architected and built is not simple. We solve very hard problems for our customers. It requires depth of domain knowledge, and in reflecting the physics of the supply chain. You really need to understand how all of this connects to each other and have deep mathematical modeling, competencies. So someone who's just going to be vibe coding their way through it, they may be able to create more simplistic applications, but ours is a very complex domain, and we feel very confident in our ability to sustain our market leadership. Now, we're not standing still. We're investing, we're innovating, we're transforming as well. But we feel pretty confident in our competitive stance at this time.
Where's your investment focusing?
Really, it's in investing in our core platform, right? So both in terms of building out our core AI-driven planning capabilities, but also in building out an extensible and a composable agentic architecture where we are investing in an expanded data fabric, in a semantic layer, and then all the agentic infrastructure to create composable orchestration use cases. That's really where our bulk of our investments are going. In addition to that, we're also expanding our coverage model and our go-to-market reach as well. We had a fantastic Q4 in 2025. We announced our earnings and had our earnings call earlier today. And we want to continue that momentum because ultimately we have an incredible opportunity to grow both within our existing customers. We have over 400 customers, and also in net new logos, because there's about 14,000 companies we can be going after around the world. We want to attack that in a thoughtful, systematic way, but we're really investing in both in our platform as well as our go-to-market.
Okay, and you mentioned earlier about day one. It's not quite day one for you, but you've been there 2 months, I guess, now about. And but the news today, Blaine Fitzgerald is stepping down May 8th. What has it been like for you? And then moving forward, who are you looking for? Who do you find to replace him?
Yeah, look, the team at Kinaxis has been super welcoming. And as you can imagine, my first 30, 60 days, I've really been focused on listening, learning, assessing. I've also been talking up and down across the organization, but also engaging with our customers. I've talked to about 25 customers in the last several weeks, talked to several of our partners that are an important part of our ecosystem as we scale up the business. And I couldn't be any more excited than my first day on the job in our ability to build and scale the business. It's an incredible business. I feel really fortunate to be a part of that. Blaine, Blaine has been a fantastic partner. It's been really good to work with him last couple of months. He's pursuing his his next phase in his career. And he's going to be with us through early May when we have our next earnings call. But, we're working very collaboratively. We've started an executive search for the CFO role. Really what I'm looking for is someone who's going to really have, the CFO background, have experience in working with publicly traded companies, particularly SaaS and tech companies, and someone who's going to be an important partner for me as we build and scale the business in the coming, several years. We've started the search now, and in the meantime, Blaine is very much involved in continuing to making sure there's no disruption to the business.
Okay, we have to end it there, but Razat, thank you very much for joining us.
Thank you.
Razat Garoff is the CEO of Kinaxis. Coming up, the Toronto Regional Real Estate Board recently reported that home sales in the Greater Toronto Area fell last month. We'll tell you why after the break. Toronto Regional Real Estate Board reported that home prices in Toronto fell in February, the 9th straight monthly decline. Joining us now is Jason Mercer, the Regional Real Estate Board's Chief Information Officer. Jason, thanks as always for joining us. Another tough month for the GTA.
Yeah, it's interesting. So, I mean, obviously, turning the page from 2025 into 2026, we continue to see sales down on a year-over-year basis. But one of the things we pointed out in today's release was that new listings were actually down by a substantially greater amount. And so, if that trend continues as we move through 2026, especially into the spring and summer, we'll see a tightening in the marketplace, and that could provide some support for pricing, which I think a lot of would-be home buyers are looking for before making that decision to jump back into the marketplace.
It is a complicated time. Do we know any clear reason as to what is there one key reason that's holding people back right now, or is it a whole bunch?
Interesting. Sorry, it's a really interesting point. Like if you put aside, all the economic trade and now obviously the disruption we're seeing out of the Middle East as well, if you put all that aside and just look at affordability, we've seen a massive improvement in terms of the household income required to purchase, say, $1 million home in the GTA. And so if that were the only issue, we would be seeing a lot more home sales today. But I think there's just a lot of uncertainty on the minds of would-be home buyers right now, whether you're thinking about your employment situation, your income situation vis-a-vis, trade and tariffs, or whether you're talking about, what's going on in the Middle East and how that could impact your decision making. So there's just been a lot of volatility, a lot of change. And I think if you don't have to buy a home right now, a lot of people are taking a wait and see attitude.
And how much of a factor is, I know a lot of people have been waiting for bank cuts, rate cuts, and we're not seeing them. And we're also not, and when we do, we're not necessarily seeing them in the mortgage rates either.
Mm-hmm. Yeah, I mean, our assumption as we move through 2026 is we're not going to see much more relief on the borrowing cost side. Likely through the first half of this year, we'll see a little bit more relief on the pricing front. But, as I say, if market conditions continue to tighten, we'll see a bit of a floor on pricing. And I think that'll be a bit of a catalyst to see some home buyers move into the marketplace.
We're seeing the average house at just over $1 million, $1.009 million, I think, or 8,000. Is there one sector that's getting hit harder than the other, or is it kind of across the board?
Well, if you look at it from an inventory perspective, certainly we've seen a real uptick in inventory on the condo apartment front, and we've seen that on the rental side as well. There's a lot of secondary rental market transactions that go through Trev's MLS system as well. And so either side of that coin, there's been a lot of inventory, and so that's given both buyers and renters a lot more choice and negotiating power in the marketplace.
And how down? I know we've talked about the condo market, and we've heard some horror stories. How bad is it right now?
Yeah, I mean, if you look at pricing for condos, it's certainly, they're down a little bit more than what we've seen, on the overall average. So, 8-9% year over year as we move through February. But I mean, even if you move into that single detached side, in a lot of neighborhoods throughout the city, there's quite a bit of inventory. And so people have that choice. But I will say, if you drill down into certain communities, we are hearing about tighter market conditions from some of our brokerages anecdotally. And so, as we see listings decline and at a faster pace in sales, you could start hearing more and more of that as we move into the spring.
And moving into the spring and talking about maybe fewer houses available. I mean, eventually some people are going to have to move. Some people have to move for different reasons, but eventually they have to move. Do you think we'll see that in the spring, or is that will this push into the summer or even the fall?
I think the potential is there to have sort of a year or two halves where we see, more of the same, over the next 2 to 3 months. And then, if there is a little bit more certainty on the trade front, for example, and you see a little bit of a confidence increase, then, some buyers may move off the sidelines. And I'm particularly looking at first-time buyers where, you're experiencing, probably the most affordable conditions that we've seen in the marketplace since at least COVID, probably before that. And so seeing people move out of the rental market and into ownership, may make sense for some of these households. And indeed, if you look at some of our Ipsos polling that we released last month, we were seeing an uptick in first-time buyer intentions for 2026.
And which I guess in a way frees up, how's the rental market doing? I don't know if you have those numbers or not, but is the rental market seeing a break as well?
Yeah, I mean, right now, what we've seen for condominium apartment rentals is certainly an increase in inventory as well. And so while we are seeing growth in rental transactions year over year, there's still a substantial amount of inventory. And so we have seen average rents come off their peak, certainly over the last couple of years, but still remain quite high historically. And so that's that sort of decision point that a lot of would-be first-time buyers may have, is that, they are benefiting from a little bit more choice in the rental market, but is now the time to move into ownership and start building that equity and what have you.
And we saw the decline of population, and it's been neutral essentially for the last little while. Is that still a factor right now, or is that starting to play out?
I mean, the population question is really interesting. Like if you think back to the end of 2025 and StatsCan released a report saying, in the aggregate, population had declined, but a lot of that was on the back of temporary migrants. So, people that had been here for school or temporary work had left and they hadn't been replaced by the same number of new temporary migrants. And that was all based on federal policy. And so that definitely impacted the rental market in the short term. But if you look at sort of long-term sustained population growth, we're still seeing strong immigration into Canada and drilling down into the GTA, and so that should drive demand for both rental housing and ultimately ownership housing, over the longer term.
Those are the people that are more likely to buy as opposed to rent, then.
Well, certainly, if you look at immigrant households, a lot of them definitely choose to rent initially. But what we've also found, both through our own polling and looking at some Statistics Canada research, is they tend to move from rental into ownership more quickly than households that were born here, for example.
All right, Jason, we have to wrap it up there, but thank you as always for joining us.
You're very welcome. Thank you.
Jason Mercer is with the Toronto Regional Real Estate Board. He is the Chief Information Officer. Coming up, we've got hot picks. We'll zero in on 3 plays in the airline sector. That's when we come back. Well, today on Hot Picks, we looked at 3 airline stocks. The sector has been facing some tough headwinds this week due to rising tensions in the Middle East. For more on this, we were joined earlier by Tom Fitzgerald, an analyst at TD Cowen, and we kick things off with United.
The most attractive earnings upside due to the combination of idiosyncratic tailwinds from the various initiatives management's pursuing, as well as the really attractive industry fundamentals that have been ongoing the last handful of years.
That's interesting. What has been good for the industry in the past 10 years? Just people crazy to travel, tourism boom?
Yeah, I mean, travel demand has been very resilient. International travel demand, where United is the leader among the big U.S. airlines, that has seen really strong growth coming out of COVID. There was some debate back in 2022, 2023 about whether this was just a short-term sugar high and pent-up demand from the pandemic, and that would normalize back out. But instead, we've seen a secular leg up in really strong, robust U.S. outbound travel demand.
And what are they doing in technology that's distinctive?
That's a great question, Andy. They've had a lot of really interesting investments on their mobile app, in improving, customer communications, customer overall experience. They're installing Starlink across their whole fleet, which should be completed by the end of next year. That starts to enable interesting opportunities on the advertising angle over the long term. And then, just kind of run of the mill on the cost side, whether it's on the management team and closing the books on their accounting faster than normal using AI, or using technology and things like predictive maintenance, or recovering from irregular operations. They tend to be very forward thinking on the tech side.
I'm just looking at the stock over 5 years. It has been something of a star. We've got a 1-year chart there, but over 5 years, I'm showing the shares up more than 80%.
They've had a nice run lately as the market started to appreciate the earnings upside for the business, as they've been implementing a lot of their long-term targets since the latter part of the 2010s, and now they're starting to approach harvest mode for all their work. So it's a really exciting time for the company, and investors are excited as these good things come in and they reap what they've been sowing. That should lead to a lot higher free cash flow conversion down the line.
Okay, our chart there is showing a number close to 64%. My Bloomberg screen is showing closer to 80%. And Delta. Delta, you like to look at this one. It hasn't been such a great performer as United over 5 years, but what has this company got going for it?
They remain the leader in premium, in corporate travel, and in profitability across the U.S. airlines. They continue to enhance their revenue diversity, which we saw was a major contributor to their resilience last year. It likely will continue to be a major contributor to their resilience in the years ahead. And this is in things like growing loyalty to the long-term targets, building that into almost a $10 billion business, building up their maintenance, their third-party MRO capabilities into a multi-billion-dollar business over the years ahead, and lowering the main cabin share of revenue down to 40% from 15 years ago. It was 60%, and that really helps to de-amplify the volatility of the business.
That's interesting. So the main cabin, I guess that's the people who are paying economy flights. Traditionally, it was 60%, I think you said, of total revenue, down to 40%?
That's their long-term goal, yeah.
Oh, okay.
Yeah. But that substantially, that really lowers the volatility of the business. I mean, those are the most price-sensitive customers. That's where there's more competition from low-cost carriers. So those type of things, it helps to build more durability into the model.
I'm lucky. I have a long torso and short legs, so I don't mind sitting in steerage on aircraft. But
that's great. Gives you a lot of optionality.
Yeah,
I'm the opposite. I'm pretty lanky, so I tend to always hit the bid on buying an extra legroom seat.
Yeah, my wife too. She's not having any of those seats crushed together. Finally, Alaska Air. This stock has struggled a bit over the past 5 years, but you see promise here.
I do, and I think there's been a lot of things clouding over some exciting developments there. The macro, which has affected the whole industry, and then Alaska being a predominantly a West Coast airline, they have more exposure to West Coast fuel benchmarks, which tend to be a little more volatile than the industry, and over the last 2 years have been much more volatile. But we think if you look through the noise over the long term, as they reap the benefits from integrating Hawaiian Airlines, which they acquired in late 2024, this is a 1 + 1 = 3 type of merger. It enables a lot of network optimization, turning Seattle into a long-haul global hub. And
no, did we lose Tom there?
Sorry about that. I think I hit the mute button. Reshuffling the deck to turn Portland into a connecting hub, take more share in San Diego, optimize their Hawaiian franchise. They're leaning into premium and loyalty. And if you think about, probably about 70% of their routes are on 1,500 miles or longer, and those routes historically show a much higher propensity for consumers to pay up for the premium products. So it dovetails really nicely with the overall secular backdrop right now.
Again, that's that old circulation thing. If you're on a long route, you don't want to be crammed in. Thanks. Just, Tom, we're almost out of time. Just tell us, you spend a lot of time looking at the aviation industry. Is there something that strikes you as interesting that the public just doesn't realize about this industry?
I think the gentrification from an investor standpoint is really, in the U.S. specifically, is really important to keep in mind. And historically, there were just always way too many competitors, not chasing too few seats. Now you're moving to a period where you're probably going to have 6 major airlines competing in the big markets, and with the discount carriers focusing on underserved, less attractive markets for the majors, which I think should de-amplify the volatility in their profitability, in their revenues, and give investors more conviction in underwriting investments in the space.
Andrew was speaking with Tom Fitzgerald, an analyst at TD Cowen, and things were kicked off by talking about United Airlines. Well, Prime Minister Mark Carney has addressed the Australian Parliament, discussing shared values and the strength of future collaboration between the two countries. CTV's Abigail Beeman has more.
A warm welcome down under.
The distance between our two nations has never mattered less, and the closeness of our values has never mattered more.
In the Parliament of our shared Westminster system, Prime Minister Mark Carney highlighted many ways Australia and Canada are similar.
Two proud democracies, the true north and the land down under.
Carney spoke of coming to reaffirm the alliance as global architecture is breaking down in consecutive crises, and gave many nods to his well-received Davos speech.
Every agreement signed, every coalition deepened, every commitment made is variable geometry in practice.
And he announced Australia is signing on to the G7 Critical Minerals Alliance. Plus, there are new partnerships on AI and defense.
We're actively exploring new opportunities to protect our vast territories.
Canadian soldiers will begin training on the new radar Canada is buying from Australia later this year.
The world will always be driven by great powers, but it can also be shaped by middle powers that trust each other and act with speed and purpose.
After wrapping up his second Australian stop here in Canberra, Mark Carney heads to Tokyo for the final leg of his Indo-Pacific trip.
And that was CTV's Abigail Beeman. Well, that wraps up this edition of Trading Day. I'm Roger Peterson. Thank you very much for joining us. Have a great afternoon.